Hello, I'm Haider Malik, and welcome to the Mehmi Financial Group podcast. Today's topic is Manitoba Parts and Service Financing, keeping prairie trucks on the road. When your service bays are busy, parts inventories swell, and customer payables stretch 30 to 60 days, you need dedicated financing to cover filters, tires, hydraulics, and labor, so your trucks never sit idle. Here's how Manitoba fleets structure parts and service funding to maintain uptime and cash flow. First, let's define why a dedicated parts and service line matters. Unlike your floor plan for new rigs or term loans for heavy equipment, this revolving facility is built solely for operating expenses, parts stocking, technician wages, sublet repairs. It bridges the gap between the moment you order that turbocharger and when your customer's invoice is paid. There are three core structures: receivables secured revolver. You pledge signed service invoices, say brake overhauls or engine rebuilds, as collateral. Lenders advance up to 80% of each invoice's face value. You draw to pay your parts supplier or tech payroll, and as customers remit, you repay the revolver. Interest accrues only on the outstanding balance, matching cost to revenue. Inventory secured line. You use high value parts, engines, transmissions, steering assemblies, as collateral for a revolving credit line. Typical advance rates run 50 to 65% of wholesale cost. This lets you pre-buy seasonal spares like winter-rated batteries or cold climate filters, avoiding stockouts during Manitoba's freeze. Be a short-term term loan. For one-off projects, shop expansions, tooling purchases, or major bay upgrades, a 6 to 12-month loan at prime plus 1.5 to 2.5% lets you fund the investment and repay over a full season, keeping other lines unchanged. Choosing the right lender matters. Local banks and credit unions like Assiniboine or Cambrian offer relationship pricing and can bundle parts revolvers with your floor plan and equipment loans. Specialty service financiers underwrite quickly against your PPAS and deliver same-day draws. Compare interest rates, advance percentages, audit frequency, and unused line fees. When negotiating terms, insist on interest-only draw periods for the first 30 to 60 days to align with typical payment cycles. Set borrowing base audits to monthly if your shop runs high volumes, ensuring your line keeps pace with your invoicing. Secure accordion rights so you can expand your line mid-season as parts demand grows. Managing the facility well means issuing accurate service tickets immediately. Include part numbers, labor hours, and serial data to prevent funding delays. Notify major customers that payments should route to your financing facility's lockbox to avoid misapplied remittances. Monitor days sales outstanding on service invoices and line utilization weekly. Aim to keep DSO within your draw window to minimize interest costs. Here are 3 action steps. 1. Audit your receivables. List your top 5 service customers by monthly billing, note their terms, and gather aging data. 2. Solicit term sheets. Request proposals for a receivables revolver, an inventory secured line, and a short-term term loan from 2 banks and 1 specialty lender. Compare rates, fees, advance rates, and draw processes. 3. Model your cash flow. Build a 60-day forecast of parts payables, payroll runs, and incoming customer payments to size your facility and schedule draws precisely. By layering a receivables-backed revolver, an inventory-secured line, and selective short-term loans, and by negotiating flexible terms and managing draws strategically, you'll ensure your Manitoba parts and service operations never run out of cash or stock, keeping your prairie trucks rolling and revenue flowing. I'm Haider Malik. Thanks for listening to the Mehmi Financial Group podcast. Drive safe and finance smart.